Good day, everyone. Today's topic that we will be covering is interpretation of financial statements of a public company. So, basically, up to now, you have learned from formula number 1.1 up to formula 3.7. These have all been covered in grade 10 syllabus. Then you've done a bit of these in the grade 11 syllabus. And then from 4.1 up to 6.2 is all the new formulae which then cover the interpretation of a public company. So we know that we have a full set of financial statements which we have now already learned, that is made up of our income statement, balance sheet, the notes, then we've learned the cash flows. Now, these financial statements need to be analyzed for people to invest or give loans to the company. So that is why we interpret these financial statements by means of these formulae. So let's have a look. We've got the first one, which is your gross profit percentage on sales. That is your gross profit over sales times 100 over 1. We've got the next one, which is gross profit percentage on cost of sales, which is gross profit over cost of sales. Your operating profit over sales, operating expenses on sales, your net profit before tax on sales. These all test the profitability of a company to see whether the company is making a profit or not. These ones test the solvency, and that is the net assets. The net assets is basically your total assets minus your liabilities, but that is also equal to your ordinary share capital. Your solvency ratio is your total assets is to total liabilities. Then you have your 7 liquidity ratios. You've got your net current assets, you've got your current ratio, your asset test ratio where you take out inventories. You've got your stock turnover rate, which is per annum. You've got your stock holding period, which is in days. Your average debtors collection, also in days. Average creditors collection, also average creditors payment, also in days. Then these are the new formulae which we need to know. That is our debt equity ratio. That is basically your non-current liabilities is to your ordinary shareholders equity. Then you've got your return on total capital employed, which is your net profit before tax plus your interest expenses or your interest on loans divided by your average total capital employed. Then we've got our return to shareholders, which is made up of return on shareholders equity. That's your net profit after tax divided by your average ordinary shareholders equity. Then we've got our earnings per share, dividends per share, net assets. Again, we've done net current assets here. This is net total assets. And then we've got net assets value per share, which is your NAV, and that is your ordinary share equity divided by your number of shares in issue times 100 to get it into cents. So let's do the example together so that we can get a better understanding of these ratios. So basically here we've got an extract of the financial statements. We've got an extract of the income statement. Here we've got an extract of our balance sheet or our financial position. We've got note 5, we've got note 8, note 9, and then they're asking us to calculate all these formulae. Let's start with the easier ones. We're going to go through them as quickly as possible. Let's go with number 1. Number 1 is asking us for the gross profit on turnover. So we know for that one, our gross profit on turnover is equal to gross profit divided by turnover or sales times 100 over 1. If we have a look at our example, all this information will be found in our income statement. So we go here. There's our sales for the month. It's sitting at 1290. They haven't given us gross profit, but we know gross profit is equal to sales minus our cost of sales. So we take sales 1290,000 minus our cost of sales, which is 941,605. Divide that by our sales of 1290,000 times 100 over 1. And the answer that we get to is 27%. Okay. The next one that they're asking us for is the gross profit on cost of sales. For your gross profit on cost of sales, your formula. So they want gross profit on cost of sales, and that is made up of gross profit divide that by cost of sales times it by 100 over 1. Our gross profit, we can just take it from on top. It is actually 348,395, which is this here. Divide that by my cost of sales of 941,605 times by 100 over 1, and I get to an amount of 37%. Okay, the next one that they're asking us for is our operating expenses on turnover. So for our operating expenses on turnover, number 3, your operating expenses on turnover, turnover being sales. So we start with our operating expenses, divide that by our sales, again times by 100 over 1. We want it in a percentage. Both will be found in our income statement. Here's the extract of my income statement. There's my operating expenses. If I just go down the line, it's 195,024. So that is 195,024. Divide that by my sales, which is 129,000 times 100 over 1. And that gives me an amount of 15.12%. Okay, the next one that they're asking us for is our net profit after tax on turnover. Again, all this information will be found in our income statement. So your net profit after tax on turnover you start with your net profit after tax over turnover, which is sales, times that by 100 over 1. Now, your net profit after tax, let's have a look at our income statement or the extract of our income statement. We've got a net profit before tax of 161,363, and we've got tax of 64545. If we take the 2, we subtract that from that, and we should end up with our net profit after tax. So let's take 161,363, and we subtract the 64545. Divide that by the sales of 129,000 times 100 over 1, and the answer that we get from our net profit after tax on turnover is an amount of 7.50%. Okay, and that's it then for our profitability ratios. Now, if we want to compare them to last year, we basically look at last year's indicators, which is 2014. We're doing the extract for 2015's financial year. So if we have a look Last year, your gross profit on turnover was 28.6%. This year, it's actually decreased to 27%. That is obviously not a very good thing. However, it's not that bad considering that the decrease wasn't too big. The next one, your gross profit on cost of sales, also has decreased. Last year was 40%, this year's 37%. Gross profit on cost of sales decreasing, that would actually be a good indicator. Your operating expenses on turnover last year was 19%. This year it went to 15.12. That is actually a good thing. That means less of your turnover is being used up in your operating expenses. Finally, your net profit after tax on turnover last year was sitting on 5.8%. This year has picked up to 7.5%. That is a good indicator. If we have a look all round on this particular business, the sales on gross profit or gross profit on turnover has decreased. However, the net profit after tax on sales has increased. This could be because operating expenses has obviously decreased, the operating expenses on turnover. So that's for the profitability ratios. Let's now go on to our liquidity ratios. So the first of the liquidity ratios is your net current assets. To get to your net current assets, your net current assets, that is made up of your current assets minus your current liabilities So if we have a look, assets and liabilities will both be found in our statement of financial position or our balance sheet statement. If we have a look, they're only asking us for current assets. So they have basically put all the assets together, all the equity and the liabilities together. So if we have a look at this statement of financial position, we'll notice that the first one, which is fixed assets, is obviously a non-current asset. The next one, fixed deposits, also a non-current asset. Inventories is a current asset. Trade and other receivables is a current asset, and cash equivalents is a current asset. If we have a look at our ordinary share capital, that is owner's equity or shareholders' equity. Retained income is also shareholders' equity. Your mortgage loan is your non-current liabilities. It's your long-term liabilities. Your trade and other receivables are current liabilities as well as your short-term loans. Those are also examples of a current liability. So if we want current assets minus current liabilities, we will only take this one, that one, that one, and your trade and other payables with your short-term loans. So your inventories made up of 101, 230 plus 40120 plus 78230. Inventories, trade and other receivables, cash and cash equivalents, minus my current liabilities, which is only made up of trade and other payables, 63894 plus 30,000 of your short-term loans. So if we add this onto the if you put this onto your calculator and add that up, it gives you 219,580 for your current assets minus your current liabilities, which is sitting at 93,894. If you subtract the two, your net current assets is sitting at 125,686. 125,686. Okay, the next one that they're asking us for is our current ratio. Now you've learned this in grade 10. Your current ratio is your current assets is to your current liabilities. So let's have a look at that. So we've got number 6, which is our current ratio. That is your current assets is to your current liabilities. Okay, your current assets in the previous ratio, we calculated the current assets, and that was made up of inventories, trade and other receivables, cash and cash equivalents, and it was an amount of 219,580. Is to current liabilities, also calculated it in the previous ratio. It is made up of my trade and other payables as well as my short-term loans, and that was an amount of 93894. 93894. When we are doing a ratio where we have one compared to the other, we always make the right-hand side equal to 1. So in order to make the current liabilities equal to 1, we need to divide it by itself. So we divide 93894 by itself, it will give me 1. But because we've divided the right-hand side by 93894, we need to do exactly the same thing on the left-hand side. So we take 219,580 and we divide it as well by 93894, and we end up with an amount of 2,34. 2,34. Okay, let's move on to the next ratio. And the next ratio they're asking us to calculate is our acid test ratio. For our acid test ratio, we know that our formula says we need to minus. So let's do acid test ratio. For our acid test ratio, we take our current assets, but we subtract all our inventory is to current liabilities. We want our current assets but excluding our inventory, so we subtract our inventory, and that gives us acid test ratio. So we've got current assets, which is made up of 219 from the top, 580. However, we need to take away our inventories. So if we have a look here, inventory is made up of 101,230. So we take out 101,230 is to my current liabilities, which is 93,894. Exactly like the one above, we need to make the right hand side equal to 1, so we divide it by itself. If we've divided the right hand side by 93,894, we need to divide the left hand side by the same amount. So we divide this. Let's just quickly calculate it for you. That gives me an amount of 118,350. We divide that by the 93,894, and it gives me 1,26 is to 1. Okay. The next one that they're asking us for, still in liquidity, is made up, or is your rate of stock turnover. Your rate of stock turnover. Let's have a look at that formula. Your rate of stock turnover, rate of stock turnover is equal to your cost of sales. This was done in grade 11, divided by your average stock. This is in per annum, so you do not multiply it by 365. So This we'll find on our income statement, and this we will find on our balance sheet. So let's go and look for our cost of sales. There's my income statement. There's my cost of sales. It's 941,605. So we start 941,605. If we want an average stock, to get to average, you always take last year's plus this year's and divide it by 2 to get to an average. So obviously your stock, another word for stock or trading stock, is inventories. We take our inventories. This year it's 101,230. Last year it was 98,700. We add the 2 and we divide that by 2. So we take the 101,230 plus the 98,700 and we divide that by 2. That gives me an amount of, we have 9,42 times per annum. Okay, this is in per annum amounts. So every you turn over your stock 9,42 times every single year. Let's look at number 9. Before we analyze them, let's finish all our liquidity ratios and then we'll analyze each ratio. Number 9 is your stock holding period. For your stock holding period, remember this one is in days. So you always multiply it by 365. So for your stock holding period, you take your average trading stock and you divide that by your cost of sales and you multiply it by 365 because obviously this is in days, so it's 365 days in the year. For your average stock, it's exactly like the top one, so it's 101,230 plus 98,700 divided by 2 to get to average. Your cost of sales we've already found on your income statement. It's 941,605 and then times it by 365 for 365 days in an annum. That gives me 99,965 divided by 941,605 times 365 over 1. So if I actually divide the 2 and multiply it by 365, I get to 39 days. Rounded up, the actual answer is the actual answer is 38,62. However, we'll round it up to 39 days. So you keep your stock for a total of 39 days before, or an average of 39 days. Let's look at the next formula that they're asking us for, and that is the debtors collection period. So number 10 is your debtors collection period. How often do you collect funds from your debtors? So for your debtors collection period, you take your average debtors divide that by how much sales you had on credit. So divide that by your credit sales. Again, you want it in days. So times 365, there's 365 days in the year. And we take average debtors. Debtors are obviously found as well on our statement of financial position or balance sheet. There's my average or my debtors. It's trade and other receivables. Here's the note. we always take our net trade debtors. Don't take actual trade debtors, because remember, you need to make provision for those debts that will not pay you or will go bad. So you always take your net trade debtors. You need the average, so you take the 2 and you add them and divide by 2. So we go with 38, 620 plus 3474. Divide that by 2. Divide that by your credit sales. Now, they've given it to us in our additional information, because this wouldn't be found in an actual statement. So we take we go to additional information. They've given us credit sales, which amounts to 247,678. So we divide it by 247,678. And we want it in days, so we multiply by 365 over 1. This gives me an amount of 51 days rounded up. Okay, you will get to 50, 50,91, but we make that 51 days. If you do write it as 50,91, that's also perfectly fine. This last one that they want in liquidity ratios is your creditors payment period. So let's do our creditors payment period. Creditors payment period, exactly the same as our debtors collection. However, we now take our average creditors, we divide that by credit purchases this time, multiply it by 365 over 1. For your average creditors, you will find that also in the balance sheet, or rather in the note, this particular instance. There's our note number 9, trade and other payables. There's my trade creditors. I need the average, so I add the 2 and divide by 2. I have 22,094 plus 29,429. Divide that by 2. Divide the entire thing by my credit purchases. I find that in my additional information. There's my credit purchases of 228,125 times 365, because I want it in days, and my answer is an average of 41 days rounded up. If you wrote the answer in 40, whatever the answer is, that's also perfectly fine. If you've rounded it up, that's also okay. So that's it for the liquidity ratios. Let us quickly use our ratios of 2015 to compare it to 2014's ratio. If we look at our net current asset, well, they didn't give us net current assets, so that's fine. Let's look at our current ratio. If you have a look at your current ratio, in 2014, you had 2,2 current assets for every 1 current liability. In 2015, it's increased slightly to 2,34 current assets for every 1 current liability. That's obviously a good thing, because it's always a good sign if this is increasing. Your asset test ratio. For your asset test ratio, this ratio basically tells you how much of your current assets are tied up in inventories or in trading stock. Last year's current asset test ratio was sitting at 1,1:1. Again, good indication. This year it's 1,26:1. Generally, if this is lower than 1, then that is a sign that too much of your current assets is tied up in trading stock. That means your business is keeping too much of trading stock on hand, and obviously they are bound to either go out of fashion or sort of go off or just reach its expiry date, which is obviously going to result in a loss. Let's look at the next one, your rate of stock turnover. Now, last year's rate of stock turnover, we turned over our stock 7.8 times per annum. This year, we're turning over our stock 9.42 times per annum. That's obviously 2 more times per year compared to last year. That's obviously a good thing. That means we're selling more stock. That is why we need to turn it over or buy more stock in the year. Your stock holding period, last year we were holding stock for 40 days. This year we are not much further. We're only holding it for 39 days. That's just 1 day less. Also a good thing. If we have a look at our debtors collection period, last year it took us 55 days on average to get our money from our debtors. This year we managed to get it within 51 days. That's obviously a good thing. The quicker you get your money from your debtors, obviously the better for you. How often or how quickly do you pay your creditors? On average, it took you last year 45 days to pay your creditors. This year, you're paying them also a lot earlier. However, it wouldn't be bad if this increased so that you take a little bit longer. However, you can't take too long because then also your creditors will then charge you interest. So that's it for liquidity ratios. Let's go on to the 2 solvency ratios, and then we start our return ratios and risk ratios, which is for this particular topic. So for the next one, solvency ratios, they're asking you for your net assets. Number 12, my net assets is equal to total assets minus total liabilities. This compared to your current net assets, that was current assets minus current liabilities. This is total assets minus total liabilities. Now bear in mind, total assets is obviously made up of current assets plus non-current assets, and your total liabilities is your current liabilities plus your non-current liabilities. So all this information will be found on our statement of financial position or our balance sheet. There's my assets, so it's the total assets, so I need current assets and my non-current assets. Here are my current assets, there are my non-current assets. I simply add them together and I get to my total assets. So my total assets are looking like 534,630 plus 5,000 for my fixed deposit plus 101,230 for my inventories plus 401,20 for trade and other receivables, as well as 78,230, and that's for my cash and cash equivalents. Minus, we might go on to the next line, my total liabilities is obviously made up of non-current liabilities as well as my current liabilities. So that is 120,000 for my mortgage loan plus 63,894 for my trade and other payables, as well as my short-term loan of 30,000. If we add them all up, we have 759,210 for total assets, minus my total liabilities, which is sitting at 213,894. If I subtract the 2, I have total assets of 545,316. Okay, that's my total net assets. Let's look at the next one, which is my solvency ratio. Also, another thing, your net assets is also equal to your shareholders' equity. Okay, this is also equal to your shareholders' equity. If you look at the accounting equation, assets is equal to owner's equity plus liabilities. If we've just said assets minus liabilities, it's then also obviously equal to your owner's equity. So the net assets is also equal to shareholders' equity. Let's look at number 13. For number 13, we have our solvency ratio. That's what they want us to calculate, our solvency ratio. So you all know your solvency ratio is total assets is to total liabilities. We don't need to calculate it again. We've got it from the top. It's 759,210 is to 213,894. Always make the right hand side equal to 1. So by dividing it by itself, 213,894. If we're doing the other side, we say 759,210. We divide that by total liabilities, 213,894, and we get to 3,54. 3,54 or 3,55 rather, let's round up. So for every one total liability, I have 3,55 assets. That's obviously a good sign in my business. Then let's have a look at last year's ratio and compare it to this year's ratio. Last year my solvency ratio was sitting at 3,1 is to 1. 3,1 is to 1. This year it's sitting at 3,55 is to 1. It's obviously increased. That means I have more assets this year compared to my liabilities as compared to last year. That's obviously a good thing. Now they want us to calculate our risk ratios. Now for your risk ratios, boys and girls, the first one they're asking you for is your debt equity ratio. Let's do our debt equity ratio. Number 14, they want my debt equity ratio. Okay, and for my debt equity ratio, my formula is non-current liabilities is to shareholders' equity. Non-current liabilities is to shareholders' equity. Now for those of you who do get lost, please make sure you do actually use your formula page. Your formula page has all the formulae that you do need, and there we go. Debt equity ratio is your non-current liabilities is to your ordinary shareholders' equity. Okay, so my non-current liabilities and my ordinary shareholders' equity will both be found on my financial position, my statement of financial position. I need non-current liabilities. I've just got one, which is my mortgage loan. So that is 120,000 is to shareholder or ordinary shareholders' equity. This, both your ordinary share capital and your retained income is both made up of your ordinary shareholders' equity. So we add the two. We'll say 376,000 plus 169,316. If we add the two, we have 120,000 is to 545,316. And where else did we see the 545,316? It is also my net assets. Do you remember we said net assets is also equal to shareholders' equity? So always make the right hand side 1, so we divide it by itself. We divide by 545,316 to make it 1. If we've divided the right hand side, we've also got to divide the left hand side. So let's divide this one also by 545,316, and we have 0.22. So my debt equity ratio, my debt is sitting at 0.22. I have equity of 1 to cover that, so obviously I am okay when it comes to paying my debts. If you look at last year's, it was 1:3.2. Last year we did not have enough equity to cover our debts, and so obviously we have done really good for ourselves in this particular business, in that we are now able to pay off our non-current liabilities. Let's look at the next formula that they want us to do, which is now all your new formulas in grade 12. And the first one is return on shareholders' equity. So for your return on shareholders' equity, if you are using your formulae page, return on shareholders' equity is your net profit after tax divided by your average ordinary shareholders' equity. Remember, average ordinary shareholders' equity. So we need to remember last year's and this year's times 100/1. So let's have a look at that. We need net. So the first thing we're doing is return on shareholders' equity which is equal to my net profit after tax, divide that by my average shareholders' equity, and times it by 100/1. My net profit after tax will be found in my income statement. I've got net profit before tax and I've got tax. If I subtract the two, I get to my net profit after tax. So let's take 161,363 minus 64545. That's my net profit after tax. And my average shareholders' equity. Now remember, shareholders' equity is made up of ordinary share capital plus retained income. And if we want average ordinary shareholders' equity, we need to obviously take this year's plus last year's and divide it by 2. So we are almost taking 4 amounts, in that we're taking this year's ordinary share capital plus this year's retained income plus last year's ordinary share capital of 352,000 plus last year's retained income, and dividing it by 2, multiplying the entire thing by 100/1. So a recap: for your ordinary average shareholders' equity, you have to take this year's shareholders' equity plus last year's shareholders' equity, bearing in mind that shareholders' equity is obviously made up of ordinary share capital plus your retained income. So if we basically put this all onto the calculator, we have 96818 for the net profit after tax. And if we have to put all of this onto the calculator, we're going to get 514,907. 514,907 times 100/1. Please don't forget, when you're adding all of this, don't forget to divide by 2. The answer that you get is 18.8%. 18.8%. That's your return on shareholders' equity. Let's look at number 16. Number 16, they're asking us to calculate your return on capital employed. So we're doing return on capital employed And so if you have a look at your formula page, your return on capital employed is equal to your net profit before tax and interest expense. So you have your net profit before tax as well as interest expense. Divide that by your average total capital employed. So your capital employed is obviously the amount of money that you've received from your shares. So let's go and quickly do that. Your net profit before tax and interest expense will obviously be found in your income statement. There's my net profit before tax, but remember this has already taken into account the interest expense. So if I want to get to net profit before tax and interest expense, I obviously need to add back that interest expense. So we need net profit before tax and interest expense. Divide that by average total capital employed. And you want this answer in cents, so you multiply it by 100. If you don't multiply it by 100, please just remember that it will then be in rands. The amount will then be in rands. So your net profit before tax and interest expense, we've got our net profit sitting at 161,363 plus my interest expense of 14,400. And I divide that by my average capital employed. Now to get your average capital employed, you need to look at all the capital that you've received. Now your average capital employed is basically made up of, so I'm going to just write it over here. Your average capital employed is basically made up of all the money that you've received through capital. Now, as a public company, you can receive capital from ordinary shares by issuing ordinary shares. So it's made up of your ordinary share equity. But remember, you can also receive money if you apply and you are granted a loan. So it's also made up of your non-current liabilities. And remember, both of these are average, because we want our average capital employed. So your average total capital employed is made up of your average ordinary share equity plus your average non-current liabilities. Now if we look, last year's non-current liabilities was sitting at 150,000. This year it's sitting at 120,000. We need average, so we add the 2 and divide it by 2. Same thing with the ordinary share capital. We take ordinary share equity. We basically take last year's plus this year's. So that's made up of 376 plus the 169 is this year's. Last year's was the 352 plus the 132 gives me last year. So we add all of that, not forgetting that we also need to add our non-current liabilities. So let's start with our ordinary share equity, 376,000 from last year, plus the 169, because remember, retained income is also part of ordinary share equity, plus 352,000 from last year, plus 132,498 from last year, plus this year's loan of 120 plus last year's loan of 150, and divide this entire thing by 2. I know it's a lot to process, but if you quickly have a look again, we've got this year's ordinary share capital plus this year's retained income. That gives me my ordinary shareholders equity for this year, plus last year's ordinary share capital plus last year's retained income. That gives me my ordinary shareholders equity for last year, plus 120,000, which is my non-current liabilities for this year, plus 150,000, which is my non-current liabilities for last year. If I simply add them all together and divide by 2, I'll get to the average of all of them. So if we basically put that all onto the calculator, we have net profit before tax and interest income of 175,763, excuse me, interest expense. Divide that by 649,907 times 100 over 1, and we have an amount of 27,04%. 27,04%. Okay. 27,04% return on average capital employed. If we can quickly just compare it to last year. Last year we got a return on average capital employed of 30%. This year we're getting a little bit less, which is obviously not a very good sign. However, the decrease is not that drastic. Let's look at the last few. We need earnings per share, dividends per share, net asset value per share, and your average issue price per share. When it comes to formula number 17 right up to formula number 20, these formulae are all the answers of all of these are in rand or cent figures. So if you opt to multiply them by 100, you can then have it in cents, or if you opt to leave it, you can have the answer in rands. So let's go to the first one. The first one they want is my earnings per share. So number 17, the first thing they're asking us for is earnings per share. And if you look at your formula sheet, earnings per share is equal to, if you look at your formula sheet, your earnings per share is equal to your net profit after tax divided by the number of shares issued. No averages, it's as is. So net profit after tax, divide that by my number of shares issued, and we can multiply it by 100 over 1 to get it to a cent amount. We need net profit after tax. We'll obviously find this information on my income statement. I've been given net profit before tax as well as taxation. I can simply subtract the two to get to my net profit after tax. So I can take 161,363 minus 64545, divide that by the number of shares that I've issued, and that I'll find on my statement of financial position or my balance sheet. There's the number of shares which I've issued this year. There's the number of shares which I've issued last year. So this year I've issued 160,000 shares times 100 over 1. And so my earnings per share is looking at 60,51 cent. 60,51 cent. If you opt not to multiply it by 100 over 1, you have 6 rand and 05 cents. That's if you don't multiply it by 1. Let's have a look at the comparison from last year. Last year we were earning 41.9 cents. So obviously we are getting a lot more per share, and that's obviously a very good thing. Let's look at number 18. The next one they want us to calculate is our dividends per share. For our dividends per share, very similar to earnings per share. Dividends per share is your dividends for the year, and that is made up of interim and final divided by the number of shares in issue. Again, if you want the answer in cents, you multiply it by 100 over 1. So you take your dividends per share, which is your total dividends. You can say interim plus final. Divide that by the number of shares issued times 100 over 1 to get it to cents. We're obviously going to find this in our note number 8, which is our retained income note. There's my total dividends. It needs to be made up of my interim plus my final. So if I take my interim, it's 20,000 plus my final, which is 40,000. I divide that by the number of shares, which we've already established above, 160,000 shares, times 100 over 1. And if I put that onto the calculator, I get to a dividends per share of 37.5 cents. If you opt not to use that, you have 3.75 cents per share. That's how much dividends you are paying per share. Now here's a little something to take note of. If you take the difference between your earnings per share and your dividends per share, that is the retained income per share. So this is how much you're earning per share. This is how much you need to pay out per share. The difference between the two, which is 6.05 minus 3.75, the difference between the two becomes your retained income per share. That is how much you get to keep. That's how much the business gets to keep per share. Again, let's compare it to last year's. Last year's dividends per share was sitting at 33.3 cents. We've obviously paid out more dividends because we've got more shares. And also, we've probably just, yes, we've obviously paid out more because it went from 33.3% to 37.5. Let's look at the next formula that they want us to do, and that is my net asset value per share. So for my net asset value per share, I basically take net assets, which remember we've calculated previously, divide that by the number of shares in issue. Again, I can multiply it by 100 to get it to cents. My net assets, remember we've calculated previously, it was an amount of 545,316. My net assets was 545,316. Remember, net assets is also equal to your ordinary shareholders' equity. It's also equal to your shareholders' equity, but remember we've calculated this already. So 545,316 divided by the number of shares in issue, which is 160,000, times 100 over 1, and that gives me an amount of 340.82 cents. Again, if you opt not to put it, it will be 334 rand and 082 cents. Okay, if you opt not to put it into cents, that is how much you will have. So that is net asset value per share. Remember, your net assets is also equal to your shareholders' equity. Okay, and then finally, the last one that they want from us is your average issue price per share. For your average issue price per share, oh well, that one we don't have, so we don't have to really stress about that one. Don't worry about number 20, just up to number 19. So that's it, boys and girls. please take note that this is the example. Please use the video to help you understand all the formulae, how to calculate, to how to analyze it, and we will then continue with activities which we'll mark through the week. Thank you very much.